Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello, and welcome to LiveSquawk's Market Talk, our weekly review. Today's recording is on Monday, the 23rd of February, 2026. For anyone new to this podcast, every week myself and guests break down the key stories of the week and look at the implications for the markets. We'll also preview the week ahead, providing you a heads up as to what you should be looking out for. For this episode, I'm joined by a regular contributor and long-time trader, friend of the show, Ryan Littlestone of Forex Analytics. Hello, Ryan. How are you doing?
Yeah, morning, Harry. I'm all good. How are you?
Very well, thank you. A bit of a different dynamic doing it on a Monday rather than on a Friday, but we'll crack on in a minute. Just a quick disclaimer, though. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. And with that, we shall crack on. We'll look at the week that was. We'll review last week, really, because there was something and nothing about last week, I think, for the most part. And we'll start with the FOMC minutes, really, that revealed the camp were, I think it's pretty fair to say, we're happy to keep rates on hold and happy to see rates stay on hold for the near term, at least. What was your impression of the minutes of last week?
Yeah, pretty much that. We know the Fed are just sitting and waiting like everyone else, waiting to see what the data's going to do. They've on one side, they've got this softening jobs market has been softening, coming down to lower levels, but then we got that surprise NFP. Now we need to know, is that going to be the start of a trend higher, or is that just a one-off when we get back to sort of double-digit gains? Inflation, as we're going to talk about, is still staying sticky, and as much as they think it's still going to come down to target, it's remains very sticky is the only word to describe it. Keep describing it, and I think that's what's keeping them on hold more than anything else.
So yes, so we might as well get on to the inflation picture and side of things anyway. We are, like you say, there's residual inflationary pressures that remain there, and we're going to get this Friday PPI data out at the back end of the week, which will help with the PCE read as well. For the most part, though, I think everyone's fairly sanguine about the upside pressures. It's just the persistence, like you say, of inflation and not really coming down as quickly as people would like to see, that's really keeping them on hold at the moment. Because from everything I've read, the other side of the gamut, the labour market, yes, we have the revisions and everything else, but people are still expecting some sort of slowdown in the US to come this year. And we'll talk about the court ruling and the tariff situation as well, because that will all play out or play into monetary policy at some point or other within the first half of this year, you'd think, wouldn't you?
Yeah, absolutely. We saw that over the tariff thing. Fed rate expectations, June flipping to July, flipping back to June. It's going to be an up and down thing.
Yeah, and I've got a Barclays thing here on the GDP input. So the BEA's advanced release showed a 1.4% quarter-over-quarter gain in real GDP, in line with Barclays tracker, and on the heels of a Q3 that was 4.4%. While the government shut down and other volatile components contributed to the slowing, continued gains in PDFP indicate resilient aggregate demand. So again, they're slightly more upbeat, saying that the overall gain reflected a solid quarter for private domestic final purchases, which the Fed will likely interpret as a signal of resilient underlying demand. And therefore, again, like you say, just keeps that persistent or the consistency of keeping rates as is. I want to turn to, how much do you want to go into this, the tariff situation at the moment and everything we saw? There wasn't the kind of reaction in the markets on Friday that maybe some would have expected. when for anyone who missed it, the IEE, is it IE? The pseudonyms for the,
IEPA or something, isn't it? Yeah.
basically went back. IEPA is what it is. Basically went back and said that the tariffs were illegal. President Trump's tariffs were illegal, and that they should be uh, rescinded. He then subsequently went on and opened up a new round of tariffs on global trading partners. This happened on Friday. What was your initial reaction to the data? As a trader who looks at the currency pairs, how did you react to that?
Yeah, well, it was very strange. I thought we might have got bigger moves. I think the market was half expecting it, though. The way we'd
Mm,
heard the noises, in the months prior coming into this, that it was potentially going to go against him, and that he had other ways and means of getting those tariffs on in some way, shape, or form. I think that's probably why we saw not much of a reaction in markets in the end. In fact, we've seen probably more of an indication coming into the new week with the dollar under fire a bit.
mm,
But we're not busting any huge moves here. It's I think what potentially drags the dollar down from here is just the uncertainty.
yeah.
Is he going to have to pay stuff back? What are other countries going to do about their reaction to it? The EU are having a meeting today about the US trade deal. China's already out saying that US needs to pull its tariffs. So I think we're in for a extended period of people not knowing what exactly is going to go on. Trump
Mm.
rushing around to try and get tariffs back on and not to destroy all the trade deals he's got going on. But I think overall the market's going to look at this and think, well, this is the same uncertainty we had when he was going through putting all the tariffs on. And I think that, is going to start weighing on the dollar a little bit, maybe in the short term.
I mean, but that situation, like you say, it doesn't really change the direction of what we've seen in terms of Trump's behavior and the way he deals with these things. He was quite bullish on, and coming out, as I said, and imposing 15% tariffs under, what's it, Section 122 import surcharge. Is the guise he's using now. ING basically agrees with you, says uncertainty does not help the dollar and is starting the week on the softer side. The fact that the US did not launch a military strike on Iran as well this weekend is probably one factor behind the dollar selling, but trade uncertainty and what it means for the US economy is another. So again, just echoing comments that you come out with. So again, a developing story on that front. I want to turn to the UK now because again, it was a busy week for UK data, headlined by, I guess, by the Jan CPI reading. Um, we know, or the predictions are, the CPI will start to soften over the coming 2 to 3 months anyway. So people were looking at this and just go, yeah, okay, fine. We've had another down print, but ultimately it was a mixed bag, wasn't it? With the core and services. Again, there's that word sticky again, a bit persistently high.
Yeah, absolutely. But it has been trending lower, and that's what the bank wants. Certainly, that's what Rachel Reeves wants. Um, with our CPI, UK CPI, there always is an element of greater inflation persistence. It's just the
Mm,
nature of things, mainly a lot to do with imported energy. Obviously, what the pound's doing related to that as well as an effect, but. The, the reason that inflation may come down quicker would be if the economy is suffering worse and worse, because then obviously people start slashing prices to drum up business, which
sure.
is what I've sort of been expecting to happen this year. But as I remarked on prior shows with you, we're seeing a bit of positivity coming into the end of the year, into the new year. The question is that going to stay in place, or is that going to drift off? Obviously, pretty much all the data was pretty good. Retail sales was good.
Mm,
The fiscal side for Reeves was good. Inflation's coming down. If we stay along that vein, then the Bank of England can bring rates down slowly and get them to a neutral level, a bit like the ECB. The problem arises is if, this good round of data disappears in February, and we're going back to what we saw in sort of Q3 onwards, where things were just softening and not looking too good. So I think there's a bit of a reprieve at the moment. The Bank of England will be happy, but I'll be wanting to see if the trend continues.
And they're happy in the sense that they don't have to pull the trigger at the moment on anything. But there is, as we know, and we've seen from the voting pattern of late, the last two votes have been by the narrowest of margins, with Bailey being the deciding factor and the pivot in one case. Um, we've talked about this before. I think it was you and Mike we talked about this, and it was just hard to understand why they're not more aligned with the situation, you know, as a committee. But as Mike pointed out, you want contention. You thoroughly work through work through any sort of decision they come to, I guess. So I get it from that perspective. And also, again, like you said, retail sales came in on the stronger side last week, sharply, as a matter of fact, in January. But again, the concerns persist, as reported online about that. We saw gains driven by auctions and online jewelry demand. So it was a narrow band of positive contributors to that gain, which may lead some to think we might see some sort of payback next month. Right. I want to go on to do you have anything else in the UK that worries you, or you know, from your sterling position perspective, that you look at, or as you said, you're happy to
Um,
sort
yeah, no, nothing really. I've been pretty bearish since last summer, just because the way the economy is going. I have no reason to change that wholesale, but as I said, this data has been better. We have finished the year off okay-ish, coming into new year okay. The PMIs on Friday were positive, so things are looking like they might be picking up, which the UK can do. A lot of people are uber bearish always, or perma bears on the UK, and we always find a way to come through it. So yeah, I'm not as bearish the UK as I was.
right.
I don't want to see next 3 months. But as for the other risk, really the only risk we've got coming up is this political stuff with Starmer, going into these sort of May elections and whatnot, and whether he's going to survive that, and that's whether the Chancellor's going to survive that. He's got a stay of execution at the moment.
Mm.
That's still bubbling on under the surface.
We do have a local election up in Greater Manchester as well, haven't we? The one at
Yeah,
Burnham. So, I mean, that will be a little litmus test, I think, to just general sentiment around the incumbent government at the moment, and how much they may suffer, really, to the likes of reform and uh, yeah, and its majority in Parliament. It won't be decided on obviously on this one seat, but again, may just give us a little test of what's to come in May. So
yeah,
watch for the currency on that front. Turning to the week ahead, obviously geopolitical situation is front and foremost at the moment, I think. Um, for anyone unaware, Japan was on holiday today. There was an Emperor's Day, or Japan Day for Emperor's birthday. So it was a quiet start to the week, maybe for a lot of Asia, or some of Asia. And we've got Chinese New Year as well. So all these factors playing into it. Um, but it is a generally quiet week on the data front. So geopolitics, as I said, will probably be at the fore. No strikes in Iran as yet, although there were murmurings over the weekend and speculation that there were attacks, but nothing as yet. But Trump still is ratcheting up a bit the rhetoric on Iran. Do you see that as a near term? Obviously, it's near term, but do you see it as a pressing issue right now?
I think it is, but he's still keeping the threats while they're still talking.
Mm.
And it looked like the market just sort of swings between the headlights. 1 minute everything's going well, they're talking. Next minute you're seeing countries pulling out their people, and we've had the weekend news that he's looking at potential targeted strikes.
Yeah.
Whether that's just part of the chest beating, the horseplay, shall we say, in negotiations remains to be seen, but he's certainly keeping the pressure on. But otherwise, they seem to be working towards a deal. And again, we just have to react to the headlines. We could get a headline. I think the next round of talks is Thursday. We could get a headline, yeah, everything's sorted, they're all agreed, and everything's fine and dandy. Or nothing gets agreed, and Trump decides to throw a few bombs around, and then we'll see, obviously, oil and markets reacting to that. So It's part of the ongoing geopolitical situation that we've been trading for the last few years now. Ukraine stuff, the same thing. So yeah, it's you can't predict anything with Trump. You
Now,
can't say, oh yeah, this is all going to be fine and dandy, because one headline and it all goes in reverse.
that must make it quite stressful to trade around. I know you're not a short-term trader, but you look at the slightly bigger picture. But all the same, you know, you've got to still remain nimble, haven't you, on the situation, on your positions, I guess.
Yeah, yeah. Because of the situation, geopolitical situation, it's hard to even take a long term view. You could have taken a long term view of tariffs. Well, that's just been blown up last week.
Mm,
So yeah, you have to come into the short term, obviously, and there's enough to trade in the short term as well. But you can't marry a position for longer than 5 minutes. You react to something, you get in the position, you trade a level, and you've got to. Me personally, I've got to be looking to take profits as soon as they're there, and maybe leaving a little bit on to run a bit, because you get complete flip around.
sure.
On the end, after the election stuff, I thought, here we go. This yen's going to strengthen for a while. We hit a big level down at 152, and it completely reversed. And now that trade is sort of dead and buried for a bit until we get further data out.
Yeah. Yeah, to me, it'd be a minefield for me at the moment. Looking elsewhere at the sort of the Canada, I said the itinerary PPI is probably the headline here. Factory orders out of the US and Chicago PMI will be data this week to keep an eye on, but it will sort of take a second here on that. On the Euro area, we've got IFO this morning, consumer sentiment and CPIs to look at. Flash CPIs, German CPI seen at 1.9% on an annual basis, HICP at 2%, both a bit lower than we saw in January. The drop in the Jan services wasn't due to VAT cut, but to smaller one-off adjustments in healthcare, according to analysts. So we'll keep an eye on that, but that seems very moribund at the moment. On the whole, the eurozone picture in terms of monetary policy. Are you looking at anything specifically in Europe this week that might change your positions around or get you thinking?
Yeah, well, I think the CPI data is going to be important, because it's not just Germany as well. We're going to be getting it from
France and
France as too. They're pretty much the opposite to the Germans. Germans have seen, again, this persistent inflation. France is well below target, and it just shows the disparity we've got between certain countries, and you can almost hear it in the different countries talking, whether it's their central bank governors or whatever, about what they're going to do.
mm,
Francis Villeroy, he's on his way out, but he's not worried about low inflation. He says that the ECB are happy where they are. They got their victory on inflation. That's one thing I do like, is when central banks get complacent, because that's when it bites them in the backside. Um, here we've got a country that you read the PMIs, and firms are still cost cutting to try and drum up business. That's the example I was using for the UK and what might drive inflation lower. And we're not seeing a pickup there in inflation. And that can't last for too long. And if the rest of the other countries go that way, then the next call is going to be for rate cuts. But the Eurozone is 18, 19 countries now, and I've got to act for all of them, not just one or two of them.
yeah, precisely. Okay, so just to again, so we've got sentiment readings as well out this week, and as I said, IFO and again the inflation side will be important to see. We're looking at inflation for Asia area as well. Australia CPI is set to remain above the RBA's target. Say analysts there. I think this is Barclays, Bank of America forecasting headline CPI out of Australia to rise 0.5% of the month and 3.7% year on year. We will hear from the RBA Governor Bullock, I think, speaking at a fireside chat as well. Moving to across the Atlantic from where we are, at least, to Canada, we got GDP Q4 seeing contracting. That's coming at the end of the week. So we're looking for a 0.2% contraction in Q4 there. Monthly GDP for December set to grow by just shy of 0.1% in December. But looking at a 0.5% year-over-year increase there. So there are bits and pieces, as I said, but really all eyes will be on further how I guess nations respond to the new imposition of tariffs from the US president, the Iranian situation this week, and then as I said, at the end of the week, we're looking at prices data, particularly from the Eurozone's two largest states, Germany and France. But then we have that PPI data out of the US as well that will help factor PCE and core PCE price forecasts as well. So, yeah, not the busiest week on the data front, but enough to really keep you occupied. It's a shorter version this week. We just want to knock this out on a Monday morning so everyone gets an idea of what's to come. Right.
Mate, we've also got the conference board, consumer confidence. Smile, I don't know if you mentioned that one.
No, I didn't, did I? Yes.
That'll be that could be a bit of a price mover because those Michigan and some of the other numbers not been overly great coming into the new year, so that might be another indication because retail sales were a bit flat. That might be another indication that perhaps there's trouble brewing for the consumer.
Oh, well, we also got factory orders and durable goods coming later this morning as well as some house data as well as the conference board tomorrow, and Chicago PMI I think on Friday as well. So yeah, lots of survey indicators out there to pay attention to. I don't often get, well, maybe we'll see more of a movement because there's less out this week, but that conference, people seem to take it or leave it from time to time. It kind of falls off my radar a little bit, but yeah, you make a good point to just to keep an eye out for that. Ryan, thank you very much for taking part today.
A pleasure, mate. Always a pleasure.
Brilliant. And we'll get your partner in crime on again, Michael Brown, in the near future as well. It's always good banter with you guys. But thank you for your insights today.
Thanks, mate.
Awesome. Anyone who missed the start of this show can go back onto the podcast platforms, iTunes or Amazon Music, and pick this up, or Spotify for that matter. Or you can go onto the social media platforms, X, YouTube, and the like, and listen back on there too. Thank you guys for listening, and we'll see you again for another episode later in the week. Thanks for tuning into the LiveSquawk podcast. Your edge in the market starts here. Subscribe now.